Investing Simplified for beginners. Ever wondered how you can invest like a pro without the complexities? Imagine something like a magic box that lets you own pieces of various valuable stuff. That's what ETFs are, a simple way to get into the investing game. In this video, we'll unlock the secrets of exchange-traded funds and how they can turn you into a savvy investor. Watch this video to explore the world of ETFs and make your money work for you. Here we begin. An ETF, or exchange-traded fund, is like a stock that you can buy and sell throughout the day. It's different from mutual funds, which only trade once a day. ETFs are often cheaper and easier to trade. What makes ETFs special is that they're like a mixed bag of investments. Instead of just one thing like a single stock, they can hold many different things like stocks, bonds, or commodities. This mix makes them great for spreading your investment risks, which is called diversification. ETFs can focus on many areas like stocks from various industries or banks worldwide. They're like mini investment portfolios that you can buy and sell easily during the day. One cool thing is that ETFs have a share price, making them easy to trade. You can also do something called selling short, which is a way to make money if the price goes down. So ETFs are a smart way to invest in lots of things without too much hassle. What to look for when selecting an ETF? Investing in ETFs is a straightforward process. First, you'll need a brokerage account, and how you put money into it depends on the broker you choose. Once your account is funded, you can start looking for ETFs to buy and sell, just like you do with stocks. And to find the right ETF, some screening tools help you filter through the many options. These tools let you sort ETFs based on factors like trading volume, which shows how popular a fund is. Higher trading volume usually means it's easier to buy or sell that fund. Then there's the expense ratio. Lower is better because it means fewer fees. But sometimes it's okay to consider more expensive funds if they perform well. Performance is another factor to look at, even though past success doesn't guarantee future gains. You can also check what's inside each fund, which helps you see what you're investing in. Some ETFs are commission-free, which means you won't pay fees for trading, but it's still a good idea to check if there are any hidden costs. So once you have your brokerage account set up and funded and the ETFs you want to invest in sorted out, you're all set to start building your investment portfolio. It's a simple way to make your money work for you. And with these factors, remember 3 rules to get rich in ETF investing. First, avoid choosing multiple ETFs in the same category. It spreads your money thin. Second, determine your investment goal, like what you're saving for. Third, stay consistent. Decide how much you can comfortably invest each month and set up an automatic transfer. Even if it's just $250 every month, it can add up to over $1.3 million in 40 years, not to mention any dividends or extra income. So stick with your plan, and over time, your investments can grow big. Now comes the top ETF categories for beginners. The first ETF category is the S&P 500 and Total Stock Market. The first category of ETFs is the S&P 500 and Total Stock Market. These ETFs are like the bedrock of investing, serving as the foundation for almost anything you plan to do. They're like a reflection of what the entire stock market is up to. The first ETF in this category is VTI, a Vanguard fund representing the total stock market. VTI includes a whopping 4,000 individual company stocks, and its expense ratio is super low, just 0.03%. Over the past decade, it's averaged an 11% appreciation. That means if you invested money in VTI 10 years ago, your investment would be worth 11% more today. The second ETF here is VOO, another Vanguard fund that tracks the S&P 500. This fund contains stocks from the top 500 companies in the United States, which have the highest market value. Like VTI, it also has an ultra-low expense ratio of 0.03%. Over the last 10 years, it's seen an average appreciation of over 11.5%. Both VTI and VOO are pretty similar when you compare them. They both have strong track records and are very much alike. They're like 2 peas in a pod with almost identical performance. When choosing between the two, some people wonder which is better, VTI or VOO. It's a bit like choosing between 2 delicious flavors of ice cream. But honestly, you can't really go wrong with either of them. They both have strong track records and offer a great way to start your investment journey. So whether you pick VTI or VOO, you're off to a good start in your investment adventure. ETF category for most explosive gains, getting rich with growth ETFs. Now comes another thrilling category of ETFs, growth ETFs. These are the ones that can give you explosive gains, but they come with a bit of a roller coaster ride. They can shoot up, but also drop sharply. First up in this is QQQ, the Invesco QQ Trust. It's packed with over 100 high-growth companies. Think technology, AI, virtual reality, augmented reality, and even blockchain. The expense ratio is 0.2%, a bit higher but not crazy for a growth fund. Over the past 10 years, it's seen an impressive average annual growth of almost 16%. That's because tech and innovation have been on fire, especially during the pandemic. The other growth ETF to consider is VUG, the Vanguard Growth ETF. This one spreads the love to more than 250 companies, so it's more diverse, but still focused on strong growth firms. What's sweet about VUG is its low expense ratio, only 0.04%, 5 times cheaper than QQQ. Over the past decade, it's appreciated at 12.9% annually. Both QQQ and VUG have been stars over the past 10 years, but they're facing a bit of a tough time recently. Remember that growth funds can be volatile, so don't be surprised if they go through ups and downs. Comparing them, they're almost identical in returns, so you can choose either one. ETF category for passive income for life. Finally, here comes the ETF category that can give you passive income for life. This one's all about high dividend yield ETFs. If you're looking to build a stream of income that flows in without much effort, these are your go-to options. Dividend ETFs in this category focus on companies that pay out consistent and high dividends. Some folks may tell you to chase after super high yields, but that can be risky. When a company offers an extremely high yield like over 6 or 7%, it's often just to attract investors. These rates can't usually be maintained in the long run. For dividend investors, consistency and low risk are key. You can take more risks with growth ETFs, but not with your dividend ETFs. And that's where VYM, the Vanguard High Dividend Yield ETF, comes in. It holds nearly 450 companies with an ultra-low expense ratio of just 0.06%. Over the past decade, it's averaged a 10% annual appreciation, offering a solid dividend yield of 3.39%. This ETF also boasts an impressive dividend growth rate, so your dividends can grow like compounding interest. Now, the real superstar in this category is SCHD, the Schwab US Dividend ETF. SCHD has a current dividend yield of 3.73%, about 15% higher than VYM. It also boasts a 10-year average appreciation of 12% annually. If you're all about consistency, SCHD is your friend. When you look at its performance over 3, 5, and 10 years, it's been more stable. This is crucial for dividend investing. You want your income to flow smoothly. SCHD might just be the best ETF out there for dividend lovers. It's the perfect choice for building a solid foundation for your passive income that can last a lifetime. So if you're in it for the long haul, SCHD is a top contender. So what do you think of these top ETFs to make money while you sleep? Comment below and subscribe for more.